And if I look at the global money supply year on year against the year on year rate of change of Bitcoin, you can see it's a dominant driving factor of the overall direction. It is not the only factor, but a dominant driving factor. Now, global money supply has been shrinking because everybody's been tightening. So that has reduced the price of Bitcoin. So that was the crypto winter was essentially in that chart. The following chart shows that the money supply is cyclical too, and the ISM leads it by 9 months. And the ISM inverted suggests that the M2 rate of change is going to start rising again. So that basically tells us things like Bitcoin and risk assets, which ties into the NASDAQ being cheap and the exponential aid stocks being relatively cheap. There is a potential big turning point in markets to come. What I'm waiting for is that turn in bond yields. I think yields are forming a head and shoulders top with 265 in the 10 years, 275 in the 10 years as the neckline. If it breaks that, then we're going back below 2%. Inflation break-evens are already falling. So we've seen them fall sharply. And I'm expecting the oil market to show more liquidation. We saw a bit glimpse of that this week where we had some really rough days in oil. And I know there's a lot of oil bulls out there, and I understand the longer term picture. And Dwight Anderson made this clear in his interview is the thing that will pause the longer term picture is a demand destruction. And Warren talks about it as well. I think we are going to see more demand destruction in a shorter, sharper period of time.
Hello and welcome to Money Talks. In today's video, global macro investor and Real Vision CEO Raoul updates about tightening of financial conditions by fastest rates in history, chance of a sharp recession, and rising inflation and restricted growth in the markets. He also talks about demand destruction and why we need to brace ourselves for the upcoming economic impact. Make sure to stick around till the end of this video where Raoul predicts why a big turning point in markets is coming. So without wasting any more time, let's dive right into the video.
I mean, there is a lot going on, and it's very noisy for a lot of people. So I'll see if I can distill my thoughts down. It really is a follow-on for the last piece I did on Real Vision on the platform and explain to people my macro view, which was that we were very likely to be going into recession. It was likely to upset markets for a period of time, and there were certain markers I was looking for that would usher into the next phase. So I'm going to walk you through in a bit more detail now where we are now. So the first chart that I want to show is the Financial Conditions Index, which is basically a combination of commodity prices, the rate of change of rates, and the rate of change of the dollar. That against the ISM, which is the Purchasing Managers Survey, which is a good guide to the business cycle, is a 9-month lead. It's one of the best indicators we've got. And what it shows is financial conditions tightened by the fastest rate in history. And that is leading us to expect that the economy is going to have a Wile E. Coyote moment where the ISM goes from 53 down to, let's say, 35. 35 is a severe, sharp recession. Now, that indicator is already bouncing as bond yields are starting to come off. And I'll come on to this a bit in a minute, and oil's come off a little bit. And it kind of suggests we're going to see a sharp recession. Now, last time I spoke about previous recessions and times that have looked similar. The one I've been following the most is 1973, 1974, where we had the Arab oil embargo. That was a supply shock. And what happened was the price of oil screamed higher, the economy collapsed, and the markets collapsed. And in that last phase, roughly where we are now, it actually went from 56 in the ISM to 30 in 4 months. It was the fastest collapse in history of the ISM. And that was caused by the supply shock in oil. And I think we've got a similar setup.
Real Vision CEO and macro expert Raoul says Bitcoin and the crypto markets are largely influenced by one macroeconomic factor. Paul said that he believes Bitcoin and the rest of the crypto markets are closely tracking the global money supply, or M2, M2 is a measure of the current money supply and takes into account cash, checking, savings, deposits, money market securities, and other easily convertible assets.
The narrative shifts from inflation and growth is bad to, okay, inflation's coming off, but growth is much worse than we expected. So what does that mean for markets? So if I look at the next chart, it's actually, I mean, I love the ISM, the business cycle. I don't know why more people don't use this stuff. So the ISM, the next chart versus the NASDAQ. The year-on-year NASDAQ is pricing in the ISM at about 41, which is almost pricing in the full sharp 1970s recession. So it's already priced it in, or close to it. Maybe there's another leg lower. The S&P in this terms would be somewhere like about 45, 46, so pricing in a recession. Discretionary stocks, consumer discretionaries, are the same as the NASDAQ, pricing in a full recession. The growth end of tech, the really growthy stuff, that's at 39. So that's really pricing in a full recession. So a lot of this is in the price. Now, we hear a lot about people talking about, Jürgen Timmer has talked about this, is the next phase down of the markets is when the earnings goes down. Well, these charts kind of suggest that's already started happening in the price. And yes, maybe there's a final leg lower as they have to price in the even lower ISM that I think is to come over the next 9 months. What is also interesting to me is that the markets tend to bottom before the ISM does. So if we go back all the way to 1947, it actually bottomed in line.
Looking at Paul's charts, the US M2 year-on-year is currently below 10%. Paul also predicts that there will be a recession in the next 12 to 18 months. Monetary conditions will be much weaker. Just to be clear, I think risk assets probably go lower before reversing, but not 100% sure. Yes, there's a risk of an extended recession like 2001-2 or 2008-9, but I don't really see that being the higher odds. I'm still using 1947, 74, and 2018 as my blended hypothesis.
So the inflation we get out of this after this recession is going to be much less than people are expecting. People are over extrapolating past prices and rate of change than current prices. So that's basically my macro view, is maybe a bit more pain to take, really unclear, won't gush lower, but the thing that will happen is that we need to brace ourselves for the economic impact. It's going to start to become clear to people, clearer than it is. People don't yet believe that story, but I think it's going to become very clear.
The crypto market endured the bear conditions for months, and the economic growth remained negative throughout the past couple of months. Finally, Raoul Pal, considered the macro guru, has explained how the markets can get the push they need. Raoul Pal is an ex-executive of Goldman Sachs. He recently got interviewed on the Real Vision YouTube channel about the economic growth of cryptocurrencies. He said that the Fed's tight monetary policies are already priced into the markets of cryptocurrencies.
I went back and looked at every single time since 1967 that the ISM crosses 50, and the Fed cut every single one except 2016, where they paused. So it tells you that the economy takes over all precedent when it comes to the things that they monitor, because then unemployment becomes more important, because unemployment means voters and other stuff, even recession. So, okay, so where are the markets, where are we pricing in other stuff? So that's 9-month lead. So the next chart to bring up is the ISM new orders less inventories. That's a 3-month lead, and that suggests the ISM in the next 3 months is going to 45, which is a full recession. So it's saying we'll be in a full recession within 3 months. Okay, that's starting to get interesting for us. Now, the issue here is inventories. So the next chart is the chart of wholesale inventories of durable goods. I mean, that chart is shocking. And there's different types of inventories, and most of them show something similar, is that inventories have gone up because everybody stocked because of the supply issue. They overstocked, and now demand has gone. Demand has gone because the financial conditions have tightened, and inflation has taken away discretionary spending. So now everybody's got too much stock. Now, building of inventories is positive for GDP in the equation for GDP, and releasing inventories is negative. Normally, to get rid of inventories, you lower prices too.
The market has already felt the agony of tightening. and therefore it is likely that the recession will back down when circumstances ease, which will be what is finally factored in, according to Raoul Paul. The cryptocurrency markets have already priced in this entire event, as he demonstrates with the chart. The interest rates are already surged upwards by 75 basis points by Federal Reserves, and this happened in the previous month. Raoul Paul believes that reducing yield and lowering commodity prices benefit risk on assets. These assets include digital assets such as crypto, and he believes that the low is close. Now, is it in or is it not? That's very hard to know.
You're seeing the tech layoffs day in, day out. So that's coming. It's not in the data yet because the data is lagged. CPI is a huge lag. The biggest lag of CPI is owner equivalent rents. So these things are all phased, which is why you tend to see after these inflationary bursts, I'm going to say something that might shock people, inflation goes negative. It went negative in 2009. It went negative in 1947. It can go negative just from the year-on-year effects, and after such big moves, the comps versus the previous year are really hard. So to end up with ongoing endless inflation is almost mathematically impossible. The question in people's minds are, can we get the 70s again where inflation came down and then it came back up again? Well, for that to happen, that was a demographic demand shock. We don't have that this time. Could we have another supply shock? Could China be a big problem? Yes. But we're going to have to move the oil price to 200, 300 to have the same magnitude of price increases with the year-on-year comps. That's a really tough call to say that that's the most likely outcome.
So what are your thoughts about Raoul's macro thesis on recession and demand destruction? Tell us in the comments. And also, don't forget to like and subscribe. I'll see you soon with the next video, and thanks so much for watching.